Hello, everyone. Welcome to another webinar by Smartkarma. I'm Michael Tegos. Today, I have the pleasure of welcoming back to the webinar Analyst Alec Tseung, who will talk about the fundamental ideas of decentralized finance or DeFi options protocols. Alec will introduce and go through the key aspects of three currently leading protocols: Opyn, RBN Finance, and Dopex. Alec is a Fintech and EM-focused analyst. He previously spent time with Tencent, where he was responsible for the group's investments in the overseas markets. Prior to Tencent, he was in the principal investments team at Swiss Re, where he focused on driving the group's investments into financial services and Fintech sectors in APAC. He has been responsible for a wide range of investments and transactions, including venture growth, buyout, direct secondaries, totaling over $5 billion. As always, please feel free to send in your questions for Alec throughout the webinar using the Q&A button on your Zoom app. We will do our best to get you to your questions at the end during our Q&A section. Please do not reshare or reproduce the contents of this webinar without our express permission. We will make sure that you receive a recording of the webinar at the end of the session. With that out of the way, Alec, welcome more officially. Thank you very much for being with us once again. I'm really looking forward to hear what you have to share with us today. So over to you.
Sure, thanks. Thanks a lot for having me as well today. So before I delve into the details of the webinar, let me just give an overview of what I'm going to talk about. So I would start off by giving a high-level introduction on the ecosystem or the landscape of the DeFi option protocols that we see in the market today. Among these protocols, we'll go through three specific protocols, namely Opyn, RBN Finance, and Dopex, in greater details in order to understand how these protocols work. Then finally, to close the presentation, I will just address the elephant in the room by giving a quick update and sharing my views on the DeFi space and the broader crypto market, given the volatility that we have seen in the market over the past 2 months. So the current ecosystem of DeFi option protocols can be divided into 2 main layers. At the bottom layer, there is the marketplace layer, or the base protocols, which other users and protocols can use to create option vaults and trading strategies. The base protocols facilitate the writing and the buying of options by ensuring and underwriting the liquidity, pricing, and so on. On top of the base protocols, there is the structured product layer, which is basically the layer where all the DeFi option vaults or DOVs are at. These vaults usually run automated option trading strategies to help depositors or liquidity providers earn a passive yield without really having to do much. All they have to do, as you will see later in the presentation when we go through RBN Finance, is to deposit their collateral there in the vault or the DOVs. In the next section, we'll go through the details of Opyn, which is at the marketplace layer, RBN Finance, which is a DOV built on top of Opyn, and also Dopex, which is both at the marketplace layer and has its own vault called Dopex single staking options, Dopex single staking option vault. So Opyn is one of the first DeFi option protocols out there in the market, which started since the end of 2019, and it helps solve one of the major challenges in trading options in a decentralized way, and that is the lack of liquidity. This is because different options might have different parameters. So each option series are different from the others, and the liquidity for each option series is therefore reduced as a result. At the beginning of DeFi options, since everything was done on a bilateral or peer-to-peer basis, so a buyer and a seller cannot easily unwind a position because there's no secondary market for them to do so. So what Opyn did was basically using tokens to represent these option contracts. So options with the same parameters will be represented by the same tokens. And if you buy these tokens, you're basically buying an option. And if you mint and sell these tokens, it's similar to selling or writing an option. And these tokens can be easily traded on decentralized exchanges. This increases the liquidity because you can now easily unwind them through the decentralized exchange by buying or selling these tokens to close your initial position. So you don't have to sell the option back to the same person who sold you the option in the first place. In the latest version of Opyn, options are European style and are cash settled. For in-the-money options at expiry, they will be exercised and settled automatically. A key game changer for Opyn this year is the launch of a new derivative contract or product called Squeeth, which is short for Squared Ether. So Squeeth basically tracks the price of Ethereum to the power of 2. For example, if Ethereum is trading at $5,000, then Squeeth will be around the level of $25 million. And if Ethereum is trading at $10,000, then Squeeth will be around the level of $100 million. So basically, whatever the price of Ethereum is squared for Squeeth. And as we can see from this chart, the payoff for Squeeth is not linear, but follows a convex function. This means when you buy or long Squeeth for the same amount of change in the underlying Ethereum price, you actually gain more when the price increases than you lose when the price decreases. Because of this convexity, so it offers pure and constant gamma, which allows users to use it to hedge against anything that doesn't have a linear payoff. We just have to buy or sell enough Squeeth in order to balance out the gamma of our overall portfolio. Squeeth is a perpetual or everlasting derivative contract with no expiry and no strike price. So these features actually help solve the liquidity issue that we see in options, where liquidity is usually fragmented among options with different strike prices, expiry dates, and other parameters. With Squeeth, the liquidity is concentrated. When we long Squeeth, our payoff is levered to the power of 2, but we're not exactly using leverage. So there's no liquidation risk when we long Squeeth. There is, however, liquidation risk when we short Squeeth. When we long Squeeth, we also have more upside and downside. And because of this favorable asymmetric payoff, the long side has to pay a premium similar to option premium to compensate the short side. And this premium is known as the funding rate. The funding rate is adjusted and included in the price of Squeeth, so the long side doesn't have to explicitly pay the short side. And because of this, so the price of Squeeth is not exactly the same as the price of Ethereum to the power of 2. And that difference is attributed to the funding premium. Squeeth is also tokenized, and the token is OSQTH. So if we want to buy Squeeth, we just have to buy the token on a decentralized exchange such as Uniswap by swapping it without Ether. With Squeeth, it also opens up more ways for users to play and trade the market, especially with Opyn's automated Squeeth strategies that allow users to trade volatility much more easily in a decentralized way instead of having to go through a centralized exchange like we did before. The second protocol that I will go through is Ribbon Finance, which I think is relatively straightforward. So if we go to the website of Ribbon Finance, we can see different option vaults that run either cover call or put selling strategies for different types of underlying tokens or cryptocurrencies, such as the ones I show here. So the first one is a cover call vault with the underlying asset being Ether. The other vault has a put selling strategy. So we have to deposit USDC into the vault in order to sell an Ether put option. We'll go through the steps in both vaults later as an example. And last time I checked, so there are still 11 vaults called Theta Vault available on Ribbon Finance. And all these vaults, they run a weekly automated selling strategies, either cover call or put selling to earn yields or option premium from the option buyers. Ribbon Finance actually charges a fee that is 2% management fee and 10% performance fee to facilitate all this. And since Ribbon Finance is built on top of Opyn, so all the options are European as well. So now let's go through the steps to participate in the two vaults I showed before. The first one is an Ether cover call vault. That means we already have Ether and we're selling a call option on Ether. So in order for us to earn the option premium, we want the strike price to be as high as possible so that the call option will expire out of money for the buyer. So first, we have to deposit the Ether that we have as collateral into the vault. The vault then will select the optimal strike price and expiry date, which is usually next Friday, using its own algorithm. Since we're selling a call option, the algorithm will select a strike price that is high enough so that the call option will expire out of the money for the buyer with reasonable market movement. The vault will then get the tokens representing these call options and then sell these tokens to earn the option premium. If the call option expires out of money, the depositors will get back their collateral and the option premium. And in case the call option expires in the money, then you will be exercised automatically and cash settled. The depositors then can only take back the collateral and minus the settlement difference. Let's also look at the USDC Ether put selling vault to understand the put selling process. The goal of this vault is for users to earn yields on USDC by selling ETH put options. So we'll have to deposit USDC into Ribbon's Theta vault. Ribbon's Theta vault will then deposit the USDC collateral into a Young vault in order to earn a yield that is generated by the Young vault. Similarly, the Theta vault will also select this optimal strike price and expiry date using its own algorithm and mint the Ether put options. Since we're now selling a put, so the algorithm will select a strike price that is low enough such that the put option will expire out of the money for the buyer with reasonable market movement. The vault will then sell these tokens representing the put options to earn the option premium. And similarly, depending on whether the put option expire in the money or out of the money, we'll get back either our collateral and the option premium or our collateral minus the settlement difference. So here I'm further showing two more vaults on Aave and Avalanche. Besides the incredibly high yield that you notice, we can also see that the cover call is a much more popular vault now than those selling put. And to a large extent, I think it also shows the broader consensus here that people are generally expecting the cryptocurrency price to continue to drop. And that's why it is a much more reasonable and sound strategy to sell a call instead of a put right now. Finally, we'll go through the key features of Dopex, which has its own vault called single staking option vault, similar to Ribbon's Theta vault. For Dopex, instead of being built on Opyn and using tokenized options to facilitate the buying and selling of options, Dopex has its own base protocol and uses liquidity pools or option pools to facilitate the selling of options, uses volume pools to encourage and facilitate the buying of options on Dopex. There's two tokens where DPX is the protocol's governance token, and the other is a rebate token called RDPX, which is minted to share losses with the liquidity providers. So to be a liquidity provider on Dopex, similar to other decentralized exchanges, you will have to deposit base or core assets into the option pool. And based on this asset, the option pool will sell option contracts to the buyers who will pay the option premium to the pool. After expiry, the LPs can get back their assets and their share of the option premium. They will also receive governance tokens as an incentive for providing liquidity there. And if the option pool incurs losses, they will also receive the rebate token, which has many different use cases on the platform as well. To incentivize users to buy options on the platform, then Dopex utilizes volume pools. Volume pools allow users to deposit funds and use these funds from the volume pools to purchase options at a 5% discount from any option pools on Dopex. So the 5% discount provides an instant arbitrage opportunity for option traders, which then encourages them to buy options on Dopex. So all these features I just mentioned are exactly how Dopex is trying to differentiate itself from the other DeFi option protocols. It maximizes liquidity by rewarding liquidity providers. With the governance token, it minimizes losses for option sellers by having the rebate token. It also maximizes gains for option buyers by creating the volume pool, which then leads to an instant arbitrage opportunity. So after going all this, I guess the fair question to ask is, what does all that even mean to us? So obviously having an option market, I think, is an important part of DeFi or in any financial market. But at the same time, it's also very exciting to see there's so much going on in DeFi. And thanks to all these option protocols, people can now easily have access to option trading strategies, similar to what Robinhood was trying to do. Besides all this, option protocols are also different in a sense that the yield people can get or generate are more organic and to a certain extent more sustainable, especially compared to yield farming, which is still how the majority of people generate the yields in DeFi nowadays. So the high yields that we see in yield farming is to a large extent a result of people banking on price appreciation of different tokens. That's why people are willing to borrow at extremely high cost, because they believe that the collateral tokens will appreciate further to compensate for the high borrowing cost they will have to pay now. So if everything goes well and the price of every token goes up, then obviously people can make a lot of money, but that's also not sustainable. Instead, if we earn yields by selling options, we're actually providing protection in the ecosystem for users, and a yield is more organic and also more sustainable. Before I open up for Q&A, let me also quickly give an update and share my views on the broader market. So over the past 2 months, ever since the collapse of Terra and Luna, I think the broader crypto market or DeFi space is just full of negative news, media attention, and also skepticism. Since then, we have seen withdrawal freezes on a list of crypto platforms, such as Celsius, Conflex, Barber Finance, and so on. The recent news on the liquidation of one of the largest crypto hedge funds, Three Arrows Capital, is just another blow to the whole sector. And surprisingly, the total value locked, or TVL, in DeFi option protocols has dropped significantly as well, as we can see from this chart. The total value locked in DeFi option protocols has dropped from more than $600 million at the beginning of May to less than $200 million as of last weekend. The TVL of the 3 protocols that we just highlighted, which are also among the top 5 most popular DeFi option protocols, has dropped on average by almost 80% since the end of April. So it's definitely not a good moment to give a presentational webinar on DeFi now as compared to 2 months ago. The market sentiment on this has obviously also changed significantly. But my view on the broader DeFi space has always been a bit cautious, but lean toward the positive side. And my optimism is not driven by the fact that I'm a crypto native or someone who's extremely skeptical about the traditional financial structure and system. As Michael introduced my background at the beginning of this webinar, I came from a very traditional financial services background where I focus on investing in traditional financial institutions at the beginning of my career, and then gradually move on to look at fintech companies and then more and more on decentralized finance. I think for a moment, we should just forget about all those buzzwords such as metaverse, Web3, or DAOs. At the end of the day, we have to ask ourselves a rather simple and fundamental question. Is virtual economy here to stay in the next 10 to 20 years? And frankly, whether we like it or not, I don't think it's going away. And so decentralized finance will always have its use case in a virtual economy and will likely stay in the future here as well. But do I think it can replace traditional finance or centralized finance in the next 10 to 15 years, like many visionaries have argued for in the past? I don't think so as well. I think the future, and by future, I mean the next 10 to 20 years, is increasingly becoming or increasingly looking like a combination of both decentralized and also centralized finance, similar to the e-commerce shop that we see today, which is a combination of online stores and also physical stores. That's why I do think it's still very important to learn and research vigorously about DeFi, even though we're likely already in another cycle of crypto winter. Okay, so I think there's a lot I have just covered, and I will stop here in the interest of time and open up for questions. So back to you, Michael.
Thank you very much, Alec. This was a great presentation, and you're right, quite a lot to digest there. But I just wanted to say that your final comment was particularly powerful. And it really, I think, answers one key question that I had, which was, with all the volatility that we're seeing in the crypto space right now, does this then signal, the sort of end for decentralized finance before it's even begun? And I think your comment really makes it clear that, while this is a challenging time, a lot of these applications and a lot of these breakthroughs are here to stay.
Yeah, so I think, it really depends on what we think DeFi is going to impact or achieve, right? So I think at the end of the day, if someone is still trying to argue that DeFi is going to replace traditional finance or centralized finance in the next 10 years, I think we all know by now it's a bit impossible and also a bit ridiculous to think like that. Right? So yeah, absolutely. I guess, but then but I think if we're trying to say that DeFi is going to shape or impact how centralized finance or how traditional financial institutions are going to work in the future, I think that's highly possible. Yeah.
Absolutely. So like we said at the beginning, I invite anyone who wishes to send in any questions for Alec using the Q&A button on your Zoom app. You can send in your questions right now. As we wait to see if there are any questions from attendees, I guess, Alec, when it comes to DeFi options protocols, I guess we are talking primarily about individual investors or retail investors. Where do institutional investors come in here, in your opinion? And what are some of the challenges that they could face coming into this space?
Yeah. So I think the challenges institutional investors will face when it comes to DeFi, I think there are two. I think the first one is custody, and the second one obviously will be regulations. On custody, I think if you are an investment, it will be easier if you're an individual, but if you are an investment management company, it's always kind of hard to decide who has the access to the private keys, right? Which is so important in the whole DeFi or in the whole crypto world, right? And then whoever has that access is then at risk, right? So at the end of the day, you probably have to work with a bank that provides that kind of institutional custody, which then is also subject to the risk of being hacked and also other kinds of security risk. I think that's one of the main challenges. The other one is on regulations, which obviously we have seen a lot of news about regulations these days because of the volatility that we've seen in the broader crypto market. I think right now, regulators around the world, they're still struggling to come up with a proper framework on how to regulate the whole DeFi space. And as a large institutional investor, you just don't want to get in too early when you have this regulatory uncertainty hanging in the air. I think because of this two major reasons, for the time being, the most of the participants in DeFi right now, and probably in the near future, will be individuals or high net worth individuals, or maybe some boutique specialized funds. Unless we see major breakthroughs in the regulations, I think the key players will remain to those parties. Yeah.
That's fair. I think the regulatory angle in particular is the greatest concern here, especially with large markets like China, for example, not having a very clear environment in that regard, or a downright hostile environment.
Yeah.
I think it's interesting that you mentioned Robinhood before, and you sort of compared DeFi options protocols to the famous app that's kind of known for gamifying investment. And of course, we all know what happened last year when a lot of inexperienced investors came in and they were allowed to trade options basically without having that knowledge beforehand. Do you think there's a similar concern for DeFi options protocols, and where could this go?
I think it's difficult to say, but I think it's possible. Right? But at least so far, I don't think we have read anything online or on the news about people losing a lot of money in DeFi option protocols because they don't know what exactly they're doing or what they're buying. And to a large extent, I think that is also because DeFi option protocols are just not that popular yet. If we compare their total value locked to the overall total value locked of the overall DeFi protocols, I think so. Right now, I think that the total value locked for DeFi option protocols is around $200 million, and the TVL for the overall DeFi protocols is, I think, about 100 billion. So if you compare these two numbers, so that is less than 1%. So I think a lot of users in DeFi nowadays, they still focus mostly or primarily on lending or liquidity mining instead of selling or buying options, right? I think in the future, if things like this if DeFi option protocols become more popular, I think this is definitely an area that should warrant a lot more attention from regulators. Because you just don't want someone to short something like Squeeth in order to earn a premium without knowing the risk that they could lose a lot of money. They could lose a lot more money when the price drops in the game. Yeah.
Understood. That makes sense. I guess things are not moving until somebody loses quite a lot of money or enough people, I guess. An S&D asks, do you see a second Terra situation happening anytime soon? And I assume it would be the equivalent in DeFi options protocols, but yeah, what's your view on that?
I think that's a big question, right? So for now, I think for now, I mean, after Terra, obviously, there have been a lot of concerns on the largest stable coin, Tether, right? And I think there have been a lot of negative news about Tether as well, basically in the reserves they hold, since we have no transparency or visibility into what they hold. But so far, I think, even though there are a lot of concerns about Tether, I think Tether has been holding its peg against US dollars quite well. So I guess the more immediate risk is not about another stable coin exploding. I think it's more about the decrease in the drop in the Bitcoin and also Ethereum price, and how that will impact some of the existing DeFi protocols, because a lot of these protocols that we will leverage, and to a certain extent, many people don't exactly know what is really underlying all the investment they hold. And specifically to DeFi option protocols, again, I think the risk is not in the near term. I think the risk is contained. I think that also boils down to the reason I gave before, is because DeFi option protocols are not that popular yet as compared to DeFi lending or some other protocols out there. And if we look at for example, if we look at all these vaults, right? All these vaults, they're still really using very traditional, or I would say conservative strategies to play options. For example, cover call, put selling. So these strategies, they're not extremely aggressive, right? So you have a cover call strategy office because you have Ether first, and then you write a call. So I think, and you put collateral into those vaults as well. So if you lose the collateral. So I think the risk so far in DeFi option protocols is still contained. Yeah.
That's good to know. Kind of circling back to your final comment about DeFi, generally being optimistic about it and it being here to stay. We've seen breakthroughs and applications, including lending and borrowing. We've seen trading and FX, and now we're seeing options protocols. What would be the next big breakthrough here, in your opinion? So
obviously, I think there are a lot of protocols that people are working on in DeFi nowadays, such as payments, all kinds of derivatives, synthetics, NFT lending, and stuff like that, right? But if I really look at it from the perspective of, let's say, replicating or disrupting traditional finance, then I think, in my opinion, the next big thing could be insurance. Again, I might be a bit biased because I used to work in reinsurance company. But I think there's definitely demand for insurance protocols in DeFi, which is not short of the risk of being hacked. And I think, and there are products or covers already in the market provided by protocols such as Nexus Neutral to ensure against the risk of failure in certain DeFi protocols or custodians. But I think the next breakthrough might be coming from extending such insurance products into more standard insurance products against the risk that we face on our daily lives. For example, instead of just insurance coverage against certain risk in DeFi protocols, I think it will be possible to provide risk coverage for the risk that we face in our daily lives by utilizing some of the innovations in option protocols that we see today. Because if you think about it, by definition, options are insurance contracts to begin with. So yeah.
So a lot of the existing work can be be repurposed to serve that application as well.
Yeah, that's what I think. Yeah.
Absolutely, and I think it's an interesting case of seeing how the cycle works here, because that's what we've seen with a lot of fintech companies and services as well, right? Once a lot of the companies solved, payments and trading. Then we started seeing developments in insurtech and regtech and those areas. So it only makes sense for DeFi to sort of follow along there.
Yeah. And I think some of, like I mentioned Nexus Neutral. I do remember that Nexus Neutral is actually trying to develop something that will replicate like traditional insurance company or insurtech company instead of just providing risk in the DeFi space. I think they're working on a product or a cover that will insure against some net cat risk. Yeah, I think that will be interesting. Yeah.
Absolutely. There's another question, and I guess we might just take this one more and wrap it up. Is there an ETF for investing in the DeFi option space?
In terms of, well, I can't recall it off the top of my head, but I do think if you want to invest as an institutional investor, I think if we want to invest in DeFi space, I think there's a stock we could invest in. There's Coinbase, right? I think Coinbase. I mean, obviously, Coinbase is a crypto exchange, or is a centralized crypto exchange, and so you probably could argue that it's not exactly investing in DeFi. But if you look at the revenue split of Coinbase, and if you really look at the future strategy of Coinbase, I think the goal of the company is to decrease the trading revenue and to increase what they call the other revenue, and the majority of the other revenue actually being blockchain rewards. So what does that mean is, they being the middleman for the users to participate in staking and also in DeFi. And what they do is also they also provide custody for you, so you can have a Coinbase wallet. Obviously, that's not cold wallets, but still pretty good. It's a hot wallet, and you could use that wallet. Through that wallet, then you can participate in DeFi. I think that's probably a more direct way to, as for an institutional investor, to indirectly participate in DeFi without exactly holding the tokens. Yeah.
Absolutely. And there you have it. Thank you very much, Alec, for being with us today and for your presentation and answering our questions. Thank you, everyone, for attending. Please note that Alec is available for bespoke research requests or premium services. So please contact your Smartkarma account manager in this regard. Alec has also written a Smartkarma original insight on this topic, which you can find on the platform. And you can find links to that insight and to Alec's profile on Smartkarma in the chat right now. I encourage you to follow Alec's profile on Smartkarma so that you don't miss any of his upcoming insights. And for any other questions or comments, you can always email us at research@smartkarma.com. Thank you, Alec, very much once again.
Thank you, Michael. Thanks a lot.
Goodbye, everyone.